Welcome to Driving to College, and thank you for letting us help you navigate the journey. Today we'll be cruising around campus at Wichita State University in Wichita, Kansas. And I'd like to start this video with a couple of stories that have happened to me at least more than once in my career per story. And the first one is that I had a student who was heading into their final semester as a student, one semester away from graduating, and this student was a bit of a non-traditional student in that he had transferred at least probably 3-4 times in his college career and was getting a little bit older, and because of that he had maxed out his student loan capacity for federal student loans and was in my office along with our financial aid director asking us to help him with $3,000 more so that he could finish school and graduate. The second story is about a local student from the town that we're in, and he came from a respected family and he had a good reputation, great grades, and because he was an undocumented person, he was not able to borrow federal loans. He wanted to come to our school, would be a great fit. We wanted him at the school, but the gap was quite wide between what we were offering him in scholarships and what he would need to cover loans, and he was asking us for larger scholarships in order to be able to come to our school. So my options in both of those stories were basically that I could authorize larger scholarships, which essentially would have been the school writing off a greater share of tuition in order to allow the first student to graduate and the second student to come and be a student at our school, in which case we would have been able to get the student, but I would also have been responsible for the amount of money that we were giving away to each of those students. The other option could have been that I could have referred them to private loans through either a bank or some sort of lending institution in order to help them either increase loans or add on loans in order to, in the first case, finish, or in the second case, be able to afford to come to our school. And then I suppose my third option in both cases would have simply been to tell them that we didn't have the funds and to not approve their request for additional scholarship, and then essentially put the onus back on both of them to either figure out a way to fund their education or to leave and go somewhere else or not go to school at all. There is, however, a new-ish option in the higher education financing landscape that wasn't available to me, still wouldn't be at my school, and that would have been an income share agreement. You might have heard a little bit about income share agreements. They are fairly new, though they have been around since perhaps the 1970s when Yale University tried them, did not have a great success with them. They have been far more common in coding camps, or the types of educational arena where people come and get trained for computer coding at they pay some tuition, they get their coding certificate, and then they go out and get jobs. That's kind of been the arena that the income share agreements have been more common in, although they are moving more and more into your traditional four-year colleges and universities. And if you do a simple internet browser search, you will see more and more articles about them and their value. So basically, while technically not a loan, it is a new way of funding the university experience with some sort of committed to payback on the part of the student afterward. Probably the biggest difference from a traditional loan is that it doesn't accrue a set principal that then is paid back regardless of circumstance at a certain interest rate until the loan is paid off. So basically there are 4 different key factors to the income share agreements, and one is that there's always a set percentage of income that the student agrees to pay back once they graduate, so a set percentage of income. Second, there is always a minimum salary that the student has to make or they don't have any payback that month. So for instance, if the agreement says that you have to make a minimum of $35,000, and if you're below that, then you don't pay on your monthly payment, then that would be the agreement for that ISA between the student and the specific school. The third key ingredient to an ISA is that there's usually a max amount of the total payback. And by usually, I mean always. So there would be a max amount of total payback. And an example that is somewhat common would be that these agreements would say that we're going to cap out at a payback of 2.5 times the original loan. Again, these will be determined by individual schools, so you'll want to read into that. If you can find a lower max payback, that's always better. If you could find something like a 1.5 times the loan or the tuition waiver payback, that would be great. And then the fourth key ingredient is that these ISAs are capped at a total payback timeline. And a common example might be 8 years. The school might have said, we're going to front you X amount of dollars, and for whatever major you're intending to graduate with, we would like a percentage of income with a minimum salary set, with a max amount of total payback at 1.5 times the loan, and a max payback timeline of 8 years. If at the end of 8 years you haven't paid the cap of 1.5, then you'd be done. So that's the basics of what an income share agreement is. And so then we start to think about, well, how does it work? What's kind of behind the scenes of an income share agreement? And basically it works in this way. An institution or an investment firm or a donor for the institution fronts the money for the income share agreements. Students then agree on the terms that we went through, the 4 set terms that the school offers for their income share agreement. And then after the student graduates and makes more than the minimum, they begin to pay back that percentage of their income over a monthly payment system. And then finally, the institution or the investor begins to receive payments, and typically they would hope to make a little bit of a return on their investment, or at least if it's an institution, they would hope to fill back that pool of funds that is available for other students to receive the income share agreement as well. So what are the benefits to a student as far as income share agreements? The biggest benefit that I can see for students is that this could decrease significantly their out-of-pocket costs. So it could be that a school has said, if you have maxed out your Stafford loan at a certain amount and you've looked at a PLUS loan, then we are willing to cover the rest of your out-of-pocket as part of our income share agreement. And this could be beneficial for the student in that you might not have to end up working 2 or 3 jobs at 40 or 50 hours a week simply to pay for school while you're in school, which would allow you then to focus on academics and the student experience and focus on making sure that you graduate in 4 years, ideally, and end up getting a job that affords you the financial capacity to pay back your investment. The second main benefit to students is that it can help specific groups who need money to fund their education. So in the stories that I talked about in the beginning, these were 2 small subgroups of student types that have a hard time with the traditional funding situation of educational loans through the government and then through private lenders. And one is the student who life has kind of not followed a quick and easy trajectory for them, and for whatever reason they have maxed out their loans, but they're very close to graduating. And the school can help them in this way because they know that all those loans without a degree are even harder to pay off. So it can kind of cover that gap to make sure that the student can get the degree so that they can have the capacity to pay back both the income share agreement and their loans. The second sort of subgroup that it could be helpful for are students who are not able to borrow federal loans. So typically these might be undocumented students, but there might be other types of students. For some reason, the traditional loan bucket isn't available for them, so they might be reliant upon the school or the income share agreement to cover some of their costs so that they can't afford to go to school in the first place. Another benefit for the student is, I believe, found in income share agreements in the guaranteed caps with the max payments and the max number of years and the flexibility to perhaps not have to make payments if and when they find themselves making less than a certain amount of money. So what that will allow them to do is essentially have a no penalty type of situation should they at some point decide that they're going to leave the workforce to raise a family, perhaps to go back to school, then all of a sudden they are not saddled with the income share agreement payments while they're doing that. So then the other side of the benefits would be the concerns. What would be the main concerns that I would have if my son was looking into an income share agreement and I were advising him? And I think while the terms might sound great, my concern would be the terms themselves. So I would definitely want to read the contract. I would ask a ton of questions, and I wouldn't stop reading and asking until I understood completely the terms of the income share agreement. I do think that there is potential in income share agreements for a significant amount of payback on a loan. I think it is somewhat common for income share agreements to have a cap of 2.5 times the loan as a max or capped payback amount. And so if you borrow $10,000 and you have a 2.5 times payback rate, it's possible that if you make enough money, you're paying $25,000 back on a $10,000 loan. And that would concern me because that's a pretty high rate. The other area of concern might be for me on that there might be a lower max. So the max might be a 1.75 payback total, but the percentage per month of income that the student has to pay might be a little bit higher. And then I would have some concern that should my son want to go into something like teaching or something that is a great career but does not pay as well up front, that higher percentage of monthly payment for the ISA might be pretty tough for them to make in those first few years when they're making enough money to owe some payback on the ISA, but not enough money to feel comfortable in life with all their payments. So were I looking into an income share agreement for my son, I would definitely look for a lower max payback. So I would look for anything below 2 times the max payback. And I would be very curious also to find a good percentage of income that would be a part of that contract. And then overall contract length. All 3 of those I would be looking for. Now the hard part about that is that each school sets their own. So it may not be all that negotiable, and it may be set at a school that you like, but as long as you're not backed into feeling desperate that your student has to attend one specific school, then you can always walk away and find another school. So another risk I might have would be if my student were going into a STEM field or a high money field, I might think that they would end up paying back more than some other students because we knew they would be making better money after they graduate. So I'd be careful that the income share agreement compensated a little bit for potentially high earning careers with lower percentages and lower max caps. And then on the flip side, I would want to be really careful if he was looking into a career that was probably going to get him a job and make him a regular salary, but probably be pretty low, as we mentioned earlier. So then we might be asking ourselves at this time, so why would schools do ISAs? And so here's a part of the video where I'll kind of pull the curtain back on what happens behind the scenes with schools and talk a little bit about why I think schools are considering income share agreements. And I think one way is a really nice idea and is a good thing that schools can do, which is to focus on target populations who struggle to be able to afford school in order to offer them an opportunity to get that degree in the education and move forward in life with a college degree. I think that there's also an element that is somewhat healthy in this, in that it can be a shared risk on investment. So in the stories at the beginning that I told about the senior student and the undocumented student, my options as a financial aid manager were basically to write off a greater percentage of tuition, at which point the school took on 100% of the risk, and we said, no problem, we're going to give you money off of school. And the student took it, and no matter what happened, they had already been given the discount, and there was no sort of risk investment on the student's part. So in an income share agreement, then I would have had an option to say to them, well, okay, why don't we look at it at an income share agreement? We're willing to write off $3,000 worth of tuition, but in exchange for that, you essentially invest in yourself and say that this is going to be worth it, and you're willing to pay back what percentage of that $3,000, what percentage of your income over the next few years in order to pay that back. And then I think schools might do it simply to increase enrollment. We have a a time period where there are more and more options for students, and attracting and enrolling the right number of students is very difficult for schools. And so it could be that schools are looking to this as another option that can help them in a competitive landscape, so that instead of a student looking at an out-of-pocket amount that is too expensive so that they walk away, they may be able to afford to stay, and it can be a win-win situation. So as you're looking into ways to fund the educational experience for your son or daughter, I wish you luck. I hope this video has helped shed a little bit of light on a fairly new program called Income Share Agreements. As always, enjoy the journey.